Concerns continue in agriculture over potential changes to the federal estate and gift tax laws. Producers are looking for guidance on what planning steps, if any, can be done and taken now to prepare for those changes. Roger McEowen with the Washburn School of Law joins us now with some guidance in today's Rural Money segment. Roger, good to have you with us. Bring us up to speed on the current situation and what's been proposed.
Well, good to be with you, Tammy. And when you say concerns in ag country, I agree with that. Boy, do I hear the concerns. The current situation is pretty good. We've got an $11.7 million unified credit exemption. That's for federal estate tax and taxable gifts made during life. That's per individual. So for spouses, that's $23.4 million that are exempt from potential federal estate tax or gift tax during life. And we get basis step up at death. So really nice things. Now, that's where we're at, and that's where we're going to be until, under current law, until we get to 2026, unless things change before then.
All right. Well, what about the valuation discounts? Will they be eliminated?
Well, the short answer to that is it looks like if the proposals pass the way they are right now, that yes, such things as marketability discounts, minority interest discounts, blockage discount for built-in gain taxes, yeah, they're going to be removed for assets in an entity that are not actively used in the business. If I have investment assets, those types of things, there'd be no valuation discount for those. So that's a tough one. And minority interest discounts, we count on those in our small, closely held farming operations where we're moving it from generation to generation. We'd like to take valuation discounts because I can't control the entity. That's the theory behind it. But those look like they would be eliminated.
Interesting. So what about the income tax basis rule at death? Will that change?
Yeah, that's really the big monster in the room, so to speak. Every farming operation in the country counts on getting that new basis equal to fair market value of the assets at the time of the decedent's death to wipe out the appreciation, say, in farmland that's been held 40, 50, maybe even more years than that has appreciated substantially over that time frame. And we get to start over at death with a new basis in the hands of the heirs equal to that fair market value. If that's eliminated, then that's a major, major change that's going to impact heirs, and it can impact even estates because there's talk that tax on that that appreciated value that's not been taxed would be taxed not only just when the heirs sell the property, but at the time of the decedent's death. So it wouldn't actually be dependent on if and when the heirs sell the property. If that happens, that's a real concern to every farm estate. Whereas the estate tax exemption, if they drop that down to, say, $3.5 million, that will affect some farms, but the basis issue is just going to affect everybody. That one's just, frankly, it's terrible if they change that.
Right. Interesting to see how all this plays out. That's Roger McEowen with the Washburn School of Law. Appreciate you joining us today.